I'm Charlotte McLeod with investingnews.com, and here today with me is Keith Weiner, founder and CEO of Monetary Metals. Thank you so much for joining me. Great to have you once again.
Thanks for having me on, Charlotte.
Really good to be catching up with you. It's been a couple of months since we were last speaking. I believe the last interview was back in June. And I remember at the time you had talked about Monetary Metals' model for determining fundamental prices for gold and silver. And at that time, the fundamental price for gold was around 2,700 per ounce, which of course that's a level that we now have gotten to. So I thought we could start there and review what's going on. Is gold catching up with the fundamentals? Is there a new fundamental price for gold? What are your thoughts?
Every day. So let me pull it up and I will tell you as of Friday, the fundamental price is 28.58. No, excuse me, 29.58. Hang on a second. My eyes are getting tired and it's late and it's really small fine print. 29.58. So fundamentals are up. And what's interesting about this market is, I think it's kind of like Pavlov's dogs. Investors get trained when they see the same pattern over and over and over and over again. It doesn't take that many times. And, we had this, it wasn't entirely a bear market. Let's call it mid 2011 through 2019, early 2020. There were up periods in it, but it was generally a time when if the price went up, everybody was suspicious. And the smart thing to do would be, if you got a big blip, sell it, because the price was surely going to come right back down. And what we saw in our data was when the price would go up, it was driven by the buying of futures. And the thing with, buyers of futures, they're using leverage, and which means that's a short-term trade. No one puts on a futures contract with leverage and holds that for years or decades. Versus when people buy coins, they stick them in a safe. Those aren't coming back to market anytime soon. They could leave them to their kids, or they can hold it for a decade or 2 decades or whatever. But when someone is playing with leverage in the futures market, that's a trade, nothing more. And either the price goes up and they hit their target and they sell out, or the price goes down and they can't take the pain anymore and they sell. And so when you see the price action being driven by futures trading, you know that price action isn't sustainable. And sure enough, time and time and time and time again, the whole gold community would get excited. Ooh, the price would go up. And we would put out an article. I had more time to write in those days than I do now. I'm a lot more busy building a business. But, I would put out an article and says, look, this isn't the durable price increase you're looking for. I'd have the Jedi mind tricks thing and, all kinds of different analogies. Aragorn from Lord of the Rings. The day will come when gold is $3,000, but today is not that day. Got tired after a while. I got tired of it. People started to hate me, for saying this. I was a wet blanket on their bull market and all this stuff. A few of them actually wrote to me and they're like, "You're keeping the price down." I'm like, "Do you really think I have that much influence? The gold market is, billions of participants, and you think my little newsletter is, going to change that?" Anyways, we are in a different market now. And this market now is not being driven by futures. It's being driven by metal. And so as the price has gone up, it's been driven by the price of metal, or by buying of metal, which means the fundamental keeps moving up. And so the fundamental is above the market price moves up, and the fundamental is moving up. And it's just been, it doesn't mean there can't be a correction. I do not want anybody to think the fundamental price, first of all, it's not a timing indicator anyway. It's just saying that there's a tension in the market, which tends to be pulling upward, which is, evidence of a bull market, obviously. But there can be corrections along the way. The more the price moves up, the more likely there's going to be a correction. But obviously not today. It's what is it? It's afternoon in New York now, and the price of gold is up, moderately. It's not massive today. And so, here we are at 2,700 something. and still going, apparently.
Yeah, I think that's exactly what I was going to ask you. It's, what does this all mean for the price? Because I think I'm still used to that attitude. When the price gets higher and higher, I start thinking, all right, when's the next shoe going to drop? When are we going to go back down? But it sounds like you're seeing this as a more durable move higher, at least for now, although there can be
Yeah,
pullbacks.
yeah, there could be a pullback, and that could be a big pullback. Um, but this is a buy the dips market rather than a sell the blips market, which it had been for, arguably 8+ years. Every time it blipped, that was the time to sell. And you'd always get that buyback opportunity lower, and you'd regret it, if you're trading it anyway, if you're just holding it. Everything, I think everyone should hold a core gold position that they don't trade. If your trading position, the price moves up $100 and you don't sell, and then it moves back down the same $100 or 110, and you're like, why didn't I sell when I had the chance? Well, this isn't that market, and if you sell here, there's a risk that you don't necessarily get the chance uh, to buy back. So this is a buy the dips. If we get a dip, buy it rather than sell the blips.
Okay, I think that helps to set the stage for gold and the rest of the conversation here. So you mentioned right now this is more of a market that's driven by physical metal. And during our last conversation, you talked about where you see demand coming from. And I'll check my notes. I think there are four key places. So China, India, Turkey, and the Arab world were the key gold buyers that you mentioned. So is that still the case right now? Are we seeing any shifts as the price goes higher? What are you seeing there?
I think I just saw some data recently that the West, which would include Japan and I think Korea, kind of have net outflows. And from everything I see in the U.S. and this would presumably include UK and Western Europe, it's moribund. I mean, volumes are down, interest is lackluster. I don't know if there's a huge amount of selling. I think there's some profit taking, but it just isn't buying because everyone's been trained in this sell the blips market, not a time to buy. And so the word on the street here, I'm in Dubai at the moment. There's a pretty strong belief that the Saudi, I don't know if it's the government or the central bank, indirectly via the government or government via the central bank, is buying a lot of gold, and I believe Saudi is not, necessarily confirming or denying that, which is fairly typical. The gold market's kind of opaque that way. It's not like shares of Apple where somebody can tell you down to the last share who owns it. Gold is a lot more opaque, and people are buying it, and there's no way to know, and all that. Um, and I tend to believe, yeah, I'm sure they're buying something, but I don't believe that the magnitude of any central bank, even Saudi, would be big enough to really be driving a market like this. The gold market's a heck of a lot bigger than most people think because virtually all of the gold mined in 5,000 years of human history is still in human hands. All of that gold is potential supply under the right conditions and at the right price. Now, obviously, it doesn't come to market every day or the price would crash, but it could. And so, the thought that somebody buying hundreds of tons would drive, the price like that, I don't believe it. So I think if they're buying, which seems plausible to me anyway, I don't have any data on it. They're buying, but along with a lot of other people are buying, and for the same reasons, which is mistrust of not only does the U.S. have insanely, gobsmackingly, stupefyingly large deficits. We're now entering, about to have an election, and neither party, let alone candidate, is even acknowledging, the elephant in the room. I like to use the term aggressively indifferent. They are aggressively indifferent to the debt and the deficit. So people in other parts of the world are like, maybe it'd be a good time to buy a little gold. And then that's, the driver of this. It's not even an inflation trade, right? So post, price. So in 2008, the spring before the crisis really began to erupt, the price of gold would hit just $1,000, right, in the spring, and then came down along with everything else. In the crisis, the gold price fell, but less than other things like stocks. And it was the first thing that was off to the races, making new highs as of January of '09. Whereas, the S&P took, a decade to recover. It's something, more than a decade, I think. No, it was 2017 or 18 or 19 before the S&P had reattained the level that it had in 2007. But gold was right there, almost immediately. And that was an inflation, fear trade that, the government was, the Treasury was doing fiscal stimulus, the Fed was doing monetary stimulus, and everyone said, oh my God, imminent inflation, if not hyperinflation. And, one of the leading names in the gold space, I'm not going to say who it is, I'm not really here to try to attack anybody, but at a conference that I was at, I was sitting in the audience in July of 2009, and he said there was hyperinflation by the end of the year. That is, by the end of 2009, the dollar was going to hyperinflate. And so massive buying of gold, and the gold price ran up from about 700 at its low in the fall of 2008 to just under 2,000 by 2011. Less than 3 years later. But the promised inflation, let alone hyperinflation, didn't really come. Now, yours truly has a monetary theory that explains why, in that environment of zero interest rates, you didn't get skyrocketing consumer prices. But that's what everybody believes. So they were buying gold, as a hedge against this or whatever. When the inflation was obvious, it wasn't coming. The gold price broke down, and then the whole thing, the trade was off, right, and that was the end of it. And then we went into those dark years of 2012, second half of 2011, but certainly 2012 through 2019. But now it's different. I don't know that, there are people that are screaming hyperinflation because they always are, but I don't know that is really the predominant view right now. But there's a view that the debt is troubling, and nobody really knows exactly where it's going to go or how it's going to play out, but it's troubling. And it seems better to own some gold than not in an environment like this. And if you're a central bank, you're thinking, what's the post-dollar reality going to be? And I don't think anybody knows the answer to that either. I have an answer, but, there isn't any paper currency that is going to replace the dollar. It's not the Brazilian real. It's not the Russian ruble. It's not the Indian rupee. It's not the Chinese yuan. It's not the South African rand. There is one thing that can replace the dollar in the end. It's gold. And I think probably they realize that at some level. It's got to be gold. There's nothing else that's going to work. So they buy gold in anticipation of that. It's a call option, maybe is how they look at it, or a hedge or whatever. But that's where we're at in 2024.
Okay, and just because you brought up the U.S. election, I think that there's been some talk of, U.S. election as a driver of the price of gold right now. How do you see it? Do you think that's important for gold or not so important for gold? You mentioned neither candidate right now has any intention seemingly of addressing the debt, interest on the debt. So yeah, thoughts on the U.S. election and gold?
I mean, in general, I'm not a big fan that something like an election has a long-term effect on market prices generally. Whether it be S&P 500 or whether it be gold, whether it be real estate. And, the reason why I bring it up isn't so much to say, oh, this election, the gold price hinges on it, because if one party wins, the gold price is going to crash to $1,000. If the other party wins, it's going to be 5,000. I don't think that's the case. I just point out that, the elephant in the room is, this debt, which is exploding, beyond. I mean, in 2008, we thought it was insane. And now, we look back in the halcyon days of 2008 and say, oh, that was cute. Like before, like under Bush, I remember everyone said the deficit was insane at $400 billion. Right. And then post 2008, the deficit was $1 trillion. And now we're running trillions. and probably going to get bigger under either candidate, going forward, because they both are talking about big spending, and not, there's no fiscal restraint. So I just pointed out, not to try to make a call on the election. I really don't know who's going to win. I've never made no secret of the fact I don't really like either party anyway. I'm much more libertarian. I want less government in our lives, and I don't think either party really wants less government. But as long as the monetary problems hanging over our head, they make a very compelling case to own gold because it's the anti-dollar. If you buy euros, you buy Swiss francs, you're buying a dollar derivative. It's like saying, I don't like Apple shares, I'm going to buy Apple call options instead. Well, that's not really a substitute for Apple shares. If you don't like Apple shares, you probably don't want to deal in the calls either. And so, gold is that thing. If you don't want Apple shares, you get into gold. And anyway, so that's what I meant by the election.
Okay. Thanks for going into that. And I think I have one more question on the US. So I believe toward the end of last week, we got another bank failure in the US, this time in Oklahoma. I don't think it was a very big bank, but I wanted to check in with you and get your thoughts on that. Should we be bracing ourselves for more bank failures at the moment? What are your thoughts?
So the big problem, what was this, a year and a half ago, I think, when Silicon Valley Bank failed, and then there were a couple other bank failures on the heels of it. The roots of that go back to 2009, right? So the stock market was crashing. Most of the crashing was over probably by fall of 2008, but it was still trending downwards. I mean, not crazily, 3.5% a day as it had been in October of 2008, but it was still going down until one announcement occurred. And that ticked the bottom perfectly. In fact, I think it was the cause of the bottom and the rebound. And that was when the Financial Accounting Standards Board, FASB, said that banks do not have to mark their assets to market. And the guy who, I'm not sure the right word is invented, but I'll use that term, invented double entry accounting, was a Renaissance man, literally in the Renaissance, named Luca Pacioli. And he was a mathematician who developed double entry accounting as kind of a way of teaching arithmetic. And he came up with something that was the most important innovation in, the corporate enterprise, certainly up until that date, arguably for centuries after that. And this is how enterprises do their books. And in his original formulation, there was the law of assets that says that when you have an asset, you keep it at the lower of A, acquisition price, or B, current market. So if the market is impaired, you got to mark it down. But you don't put it, if the market price is going up, you don't mark it up, because the accountant would say, look, we're being conservative. If you want to realize the gain and sell it, go ahead, and then you have the cash. But in the meantime, the asset is the lower of this or that. And that's how it had been for, 500 years, 400 something years, until spring of 2009, when they said, oh, you don't have to do that anymore if you're a bank. Now you can say you're holding it to maturity. You declare your intention to hold it to maturity, and no longer do you have to worry about the impairment in the market. Well, that was all the excuse the market needed to begin rallying, and there was one hell of a bull market that began at that moment and continued basically until COVID. And then once the stimulus came out for COVID, it continued to this present day. We're in that same bull market. That declaration, though, had its own problems, because if a bank has an asset that's impaired, that really is a problem. Even if the bank says, well, we don't intend to sell it, it's still a problem. And so what the rule that became was, okay, if you declare your intention to hold it to maturity, then you don't mark it to market, and also you don't hedge it. Now that's really important, because the Fed had driven the interest rates so low that by summer of 2020, when they flooded the system with so much cash. The 10-year Treasury bond was trading at about 65 basis points. Compared to today, it's at 4.1%, 410 basis points. That time was 65. And that's at the time when massive amounts of deposits were flooding into the banking system, and particularly Silicon Valley Bank. Silicon Valley Bank doesn't take retail accounts. Their depositors are venture-backed, startups and mid-stage companies. Probably not so much the Googles and Intels of the world that would have been their clients at one time. They graduate on and become clients at JP Morgan or whatever. But it's the tiers below that. And so when the VCs are flush with money and writing checks, it's flowing into Silicon Valley Bank, massive intake of deposits, and banks have to buy an asset when they get a deposit, and they're buying treasury bonds at these record high prices, which means record low yields. And then not too long after that, a couple years after that, the Fed is hiking rates, and the price of the 10-year Treasury fell like 22% from summer of 2020 to spring of 2022. So 2 years later, less than 2 years later, it's a 22% capital loss, but not a problem because the market, holds to maturity. But they didn't hedge. People said how stupid they are. They didn't hedge the interest rate risk. They bought all the treasury bonds. Now, normally, I guess if you had to market, you'd probably hedge it a little bit. But they're not allowed to hedge it. Or rather, if they hedge it, then the hedge has to be mark to market. It can't be treated as an offsetting mark against the underlying asset, which is hold to maturity. So they didn't hedge any of it. And the price really drops. And then Silicon Valley Bank got creamed in particular because the the money stopped flowing. And most of these startups are losing money. So every month they're writing checks for payroll and rent and, whatever they're doing. And so money is going out, and Silicon Valley Bank is selling assets in order to meet the outflows. You can see where this is going. And then they eventually run out of, quote unquote, good assets. And now they have to start getting into the stuff that they kicked up to the attic, the stuff that they marked as, oh, we're going to hold it to maturity, and they start selling it. And then they're realizing, massive losses on the order of 20, 25%. And it doesn't take too much of that before, they're wiped out. So, government took them over and whatever. At this point, I wouldn't expect too much more of that at the moment, although I want to put a big asterisk on that, because any bank that was going to go bankrupt over the losses and bonds just from a mark-to-market basis probably already would have fallen. Now, so at the moment, and interest rates are on the back down, trend. The Fed already cut. I'm sure they're going to cut more. I've been on the record saying that for years. You can't sustain higher rates in this, environment. But here's the asterisk. There are enormous amounts of debtors that can't service their debts. So now you're going to get impairment not on treasury bonds, but on all sorts of corporate stuff. And it's the real estate developers, and it's all kinds of things where they're impaired. And I saw a statistic that 47% of the Russell 2000 is cash flow negative at this point. So not only can't they service their debt, in fact, they can't even stay alive, at the current levels of revenues. And so when the defaults start to happen, I think there's another wave of banks that are going to go under because that's going to, inflict big losses on them. When that happens is anybody's guess. I think there are people that try to plot walls of maturities, when all these companies issued debt a few years ago at lower rates, and it might have been 5-year bonds they issued or whatever. So it takes a while before they have to come back to the market. And obviously, if they can't afford to service their debts and interest rates are much higher now than they were, then, there's a lot of defaults coming. And when that happens, I think there'll be more. But at the moment, probably not.
Okay, that was very well explained. I think really helps me understand the whole situation there. So thank you for going into that. We've been talking about factors driving gold, potentially driving gold. Is there anything else that you are watching when it comes to the precious metal at the moment?
Um, I think that's I guess that the $64 trillion question. When does the Western gold buyer realize, okay, you now have a new baseline? It's not right. So after 2008 or 2009, the baseline on gold was $1,000, and I think there was pretty much a consensus like it ain't going below 1,000 again, and it didn't. Right? I mean, gold ran up to 1980, something like that in 2011, came back down, kind of retested close to that. I think it hit 1,041 or something in, I don't know, one of those dark years, 2014 or something. But that was it. It was not going to be below 1,000, and then obviously bounced off of that, and it wanted to be more like 1,300 or 1,500. When does the consensus occur that the new baseline is north of 2,000, maybe even north of 2,500? I don't know. It's premature to say that. And when does the Western investor, come back in? And it's too premature to say, but I think at least all the elements are lining up to make that possible. The intractability of the debt, the refusal of politicians to even acknowledge it, which means the debt's going to get worse. It just becomes more and more and more ludicrous. And I think when people look at that, they're going to think, you know what, I want to have a little more gold in my portfolio. And if 10 million investors decide that, boom, there's another $200, $300, $400 added to the gold price, and the Western investors will be back in the market. That's probably the big question mark, hanging over the market right now.
I agree. That seems like a huge question right now. So we'll keep an eye on that, and we'll keep checking in with you to see how that develops. I think we've covered gold pretty well. I do also want to touch on silver. So we were talking about Monetary Metals' model for fundamental prices. And back in June, I think you had a fundamental price for silver of around $36 per ounce. And silver, of course, it's been on the move. We got past 33 last week, even approaching 34. So how do you see the silver price right now? Do you see a stronger breakout coming?
We have a fundamental price of about $34.50 as of Friday. So, it's about $1.50 above the market. But interestingly and tellingly, it's not the same as gold. It hasn't been moving. Obviously, the silver market price hasn't been moving higher and higher and higher, and the silver fundamental price hasn't been moving higher and higher either. So, yeah, I think there's more upside in the silver price, but it's not the same situation as gold. And obviously, central banks, this is a cliche. Central banks don't buy silver. Silver is much more the money of the people. It's what people who work for wages buy, because if you take 10% of a weekly wage for a skilled, let's say, blue-collar worker, that doesn't buy very much gold. It's not very satisfactory. Yes, you can buy one of those certicards with a couple gram, chip of gold floating in the little plastic window, but the same amount put into silver, and you got yourself a stack, that fits in your hand, has a satisfactory, heft to it. And so silver has always been kind of the working man's, monetary metal. And, I think it's no secret that working man is not doing particularly well. Hasn't been for a long time, which is why the silver price has languished for a long time.
So for silver you see a higher price, but in order for it to get much higher, it needs that working class type of person to be faring a little better so that they can start to buy. That's what
That'd be a
silver.
big driver.
Yeah.
Or obviously the capital owning class who tends to own gold, if they decide that silver is a relative bargain, I mean, silver, the other cliche, silver is a much smaller market. It wouldn't take nearly as much buying in silver to really make the price go bonkers. And obviously a lot of silver people write about this and are predicting it and, anticipating it and everything. And it's hard to predict these things. I mean, you can't take a straight edge to a chart and, plot a line and say, well, this is going to happen, because you're basically saying there's an inflection point when family offices and, we'll call them more adventuresome institutions are suddenly going to buy silver in quantity. It can happen. It certainly has happened in the past. But, famously Warren Buffett and Berkshire Hathaway loaded up on silver in, was it 1998 or 1999? But I don't know how, from 1996, 1997 perspective, anybody could have predicted that. And when's the next one going to happen? I don't know. I mean, again, you can look at all the factors and say they're present. It's certainly possible in this world. And a lot of people are looking at silver saying it should catch up and ultimately pass gold. In a bull market, silver outperforms gold. That's the sort of general rule. Now, the universe does not guarantee this, of course. It's not something that necessarily has to be true in all cases. And here we are with 2,700. I mean, gold making record prices practically every day. And not only in the US dollar, but in every currency. I have friends in Australia and they're like, they're all super excited. Gold hit $4,000 in Australian dollar terms. But it's making records in every currency. And well, silver should, I'll put that in air quotes, should, be, I mean, if gold is 2,700, silver should be, surely over $50. At $54, that would be what, a 50-to-1, gold silver ratio. And, well, it's not. So, could it? Yeah, it could. And could people decide that it should and bid it up there? They could. We'll see. Right now, yeah, we do see upside in the price. And as the silver price has moved up, the silver fundamental has moved up, but that's been inching up versus gold has been marching up. That's been the difference. And as you point out, it's interesting that, you remind me of what the silver fundamental had been 6 months ago. It's actually slightly lower now than it was then. So not super encouraging.
No, and I think that's a good reminder that what people think will happen or what usually happens doesn't necessarily play out. So good reminder for people interested in silver. I know you're very into debunking myths in gold, silver, precious metals. So that'll be one to watch as well, I think. And on the note of silver, I wanted to get an update. We talked last time, I believe, about Monetary Metals silver bond. So I wanted to check in with you on that, get details on that for investors who would be interested in taking a look at that.
Yeah, we have a 12% bond. So this is, all of our stuff pays metal interest on metal. So if you put in 1,000 ounces of silver, which is the minimum investment, it's a 3-year maturity. You get back 1,360. It's a little bit less than that because it's amortizing in years 2 and 3, but that's sort of the concept. So if the price of silver goes up, obviously you're doing really well. The price of silver goes down, well, you have a heck of a lot more silver at the end as kind of a buffer against the decline in the price, should it decline, which is not a prediction I'm making, by the way. I'm going to be really clear on that. This is to finance a mine called Bunker Hill. Bunker Hill trades publicly in Toronto. We are raising a bond for them of 1 million ounces. We are doing it in 3 tranches. The first 2 tranches are closed. The last tranche, we have a few more ounces left, to raise, but we're getting there to the 1 million ounces. And if anybody's interested to participate, it is for accredited investors only, but accredited investors still have a chance to get in. But the cutoff is the end of the month. And then once that's done, we'll do a press release saying, okay, this is what we did. This is what we said we were going to do. This is what we did. This is what happened. And, we're excited because, it's the same thing when we pay interest on gold. It's returning, rediscovering or unburying almost kind of like, I feel like an archaeologist. We get to the ground and we find buried stuff, and then with toothbrushes and paintbrushes, we scrape off the dust and the whatever is buried it for thousands of years and unearth it. And this idea that gold and silver are money, and then money can be invested to get a money return. The idea that you buy money and it goes up and you sell the money for what, and that's your return, right? I mean, without a yield, you have to sell the metal. And I don't know if you know Brent Johnson, on Twitter goes by the handle Santiago Capital. And he's always kind of taunting people. And he's like, as much as you love gold, you have to sell it to realize the gain. And I'm always like, yeah, but not anymore. Now you can actually get a return on it and you don't have to sell the principal. And if these things are money, which is our whole premise, you shouldn't have to sell money, to realize a gain on money. That's kind of a nonsensical, term. You should invest the money to get a money return, and now you've got interest on your money, and that's what you spend. And that's, how it was for a very long time until the welfare state and Ponzi retirement schemes and, everything else. And now money is treated as a volatile commodity, and the government's irredeemable paper scrip is treated as if that were the money. So we kind of got things upside down. And so what we're doing is, what Monetary Metals is doing is just getting this right side up again and saying, no, this silver's money as this gold. And here's a way to, get a return on it. It's a silver mine. So we're lending them money in order for them to buy the things that they need to put this mine back into production. And so it's a historic mine. It's been in production on and off for over 100 years. And went out of production, I think, when the silver price had dropped. And now, it's back in production, going back into production. And they'll amortize the loan by pulling metal out of the ground. So it's just a simple concept that makes sense. And restoring, money's utility as something that can earn a return. And so we're out to prove it. Yes, we want to make money. This is a business. But in a way, it's almost more important to prove the point. I saw an interview with somebody who knew Professor J.R.R. Tolkien, and he was gratified when Lord of the Rings really became a bestseller, and he made a lot of money on it. But the guy's point was that to Tolkien, the money was cool, but it was much more important. He'd proved his point that people actually cared about hobbits and elves and wizards and dwarves and dragons, and that's what he set out to do. And that's what we're setting out to do, is to prove this point that, the stuff really works. It's money. And if we can establish that, that's how the world is going to rediscover the path. And it's honest money. I mean, it's not, if you're using the government scrip, which is government debt, let's be really clear on that, then that enables the government to cheat and get away with all kinds of stuff. And, that counterfeiting degrades the quality, the quality of the paper, obviously, but it has a deleterious effect on the culture. Well, if they get away with that, why do I need to be upstanding in my own personal dealings, right? I mean, the fish rots from the head. So it's this erosive, corrosive force on not just the monetary system, not just the fact that consumer prices rise and, the sheer quantity of the stuff that they pump out. I make an analogy to like effluent, and they're pumping it out under high pressure, and we're just getting flooded with this credit effluent of, increasingly, large quantity and decreasing quality. Gold and silver don't allow that. It can't be counterfeited. I mean, okay, someone can try to fake it, but it's easy to tell fake metal. I was in visiting a vault one time, and they handed me two what looked like gold eagles. And they said, one's counterfeit. Can you tell which? So, I try to feel the weight in my hand, but if there was any difference between the two, the hand is not exactly a sensitive instrument. Like, they feel the same, right? I'm going to look at them. They both had the same color. They both look the same. And there happened to be a cart sitting there that they were partially filling somebody's order that had a 100-ounce silver bar on this cart. I'm like, okay, I'm going to drop both of these coins onto the silver bar to see what happens. And the first one I drop goes ting, 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 ting. And the other coin goes tink. I said, that's the fake. They said, you're the first person to think of doing that. So you can try to fake it, but it's pretty obvious and you get caught very, very quickly. And that's that honesty thing that, we as a culture, we as a society need, and the monetary system desperately needs. And that's what gold brings back. So if we can do that, the world will be in a better place. And what more can any entrepreneur ask for? Is, okay, I made money. I left the world a better place than I found it, and live happily ever after. That's what else can you ask for, right?
It does make a lot of sense, and we'll make sure to leave a link in the video description so people can check it out if they would like to learn more. Thank you for going into that. I also appreciate the literary reference there. I think we've gone through quite a bit of gold, a little bit of silver. Any thoughts that you would leave investors with as we're heading into really the last chunk of 2024?
Um, I guess one other thing that's the other elephant in the room is recession. Now, I've been on record as saying I don't think GDP is a good measure of the economy because if the government borrows $1 trillion and blows it on useless make work programs and welfare, that adds to GDP. Now, that's not a recommendation that the government should do that. That's a damning indictment that GDP is a worse than useless, at best a misleading measure of the economy. But that's how GDP was defined, of course, by socialists to incentivize precisely that behavior. But whether you use GDP or any other measure of the economy, if the economy shrinks, that's called recession, right? That and the stock market ultimately and jobs, everything that people care about, are downstream of something else, and they should be looking upstream rather than trying to predict recession based on whatever sheep entrails and eye of newt under the midsummer eve sun and our moon and all these things. Look upstream to credit, and when credit turns, when the defaults start happening, and everyone should be watching junk bonds. There's a spread between treasuries and junk. So obviously, if the interest rate on treasuries go up, of course, the interest rate on everything else goes up too. But the spread between the two, whether you use, JNK and TLT, whether you use the Bank of America Merrill Lynch, they call it option adjusted spread. There's various measures of the spread between junk and treasuries. When that spread begins to blow out, is when treasuries are really heading into this, big capital losses. That's going to hit the banks. When the banks are feeling hit, of course, they're going to pull credit back. That's going to hit good businesses that suddenly can't get the credit they need. There's going to be layoffs. There's going to be retrenchment. There's going to be, obviously, big losses declared on financial statements, and everything then contracts as a consequence of a credit event. That's what people should be looking at. And we aren't in one yet. And, I always remind people, just because you become aware of something doesn't mean it's going to happen tomorrow morning by 8:59 a.m. Probably not. If I had to guess, one other little rant, if I may, when people say, is the Fed independent or not? Everything in our world today seems to be false alternatives. And the false alternative is the Fed independent or is the Fed accountable? And then the other way of looking at it is the Fed unaccountable or is the Fed politicized? And, both of those are bad, right? I mean, if the Fed is unaccountable, the bunch of bureaucrats that control our economy rule over our lives. And no matter what they do, voters have no say. And that seems fundamentally wrong. On the other hand, a politicized Fed seems pretty scary. One of our presidential candidates thinks that the president should be able to order the Fed to just slam the interest rates to zero. And, clearly that's not good either. So that should be pretty clear. Of course, what we need to do is get rid of central planning. Central planning is intrinsically politicized, which is, in fact, the whole point. So, but anyways, I don't think the Fed is going to want to have a major economic event or crisis on the eve of an election. I think from their perspective, even though, the Fed chairman, Jay Powell, is a Republican appointed by Trump, I don't think he's going to want on his watch that a crisis happened that affected an election. There's no upside for him. Everyone is going to be blaming him, and he's going to be the bad guy, forever and probably in the history books. So they're going to want to keep on keeping on, at least through the election. Just call that politicized, if you will. Not necessarily in a partisan way, but I don't think the Fed's going to want to be perceived as somebody who gave the election to one party or the other. After that, I mean, there's only so long they can extend and pretend. There's only so many more kicks that can has left in it. And that's what we're going to find out. But I think people should be looking for that credit event, and everything else will be a consequence of it. Mass layoffs, a decrease in GDP, a big drop in stock markets. Those are all the things that happen, as a result of that credit event. Otherwise, it's just noise. Yeah, stock markets can have a correction, real estate can have a correction, but until we have the credit event, everything continues to march, up and to the right. So that's the biggie.
Okay, I think you've left us with a lot of things to think about right now and in the months and years ahead. So thank you so much for coming on to go over all of these topics. It was really helpful.
Awesome. Thanks for having me.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Keith Weiner with Monetary Metals. Thank you for watching. If you like this video, make sure to hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.